you come here on a pretty good day, a pretty busy day. I mean, the market's doing well, but you kind of see with a lot of the earnings we're getting, it does seem to be a market that's starting to kind of split apart in terms of the winners and losers. It's not sort of the everything rally that we once saw. When you're talking to clients and when you're trying to get a read on your own business, what are you hearing with regards to, I guess, the fear or the outlook of what's in this market right now?
Yeah, our clients are really struggling with what to do. And when you think about the Fed and the pivot and just seeing interest rates go down, clients have this tension of needing to stay invested, needing to earn, some type of return, whether it's for a pension or for wealth clients, but fearful that, equities look overvalued, fixed income. I hear about triple Bs getting downgraded. I'm scared. And so we have that very natural pivot about what do we do? And to some degree, people are saying, are equity markets ahead of fixed income? And while credit spreads have tightened quite a bit, I think the answer is yes. So that's another example of how you're seeing a little bit of a dichotomy in terms of what markets are telling us.
And so therefore, are you telling your clients, stay invested, ride this out, try and take a longer term perspective than the moves on an individual day?
Yes. Kind of our core view right now is that, yes, stock market has progressed very nicely. However, there's still opportunities, large cap within the U.S., some EM opportunities. So overall, there are pockets within equities that you can still earn the returns, as well as our core view is that this is a mid-cycle slowdown. Fed responded pretty aggressively with that pivot to tightening financial conditions, and so we're not projecting, a near-term recession within the U.S. So this is an environment where you want to keep some dry powder. You're going to see some corporate credit challenges, but nothing broad-based, so a little too early to get overly defensive.
I really liked how you talked about the divergence between equities and bonds. You have equities near a record high, and yet bonds still touching price higher, yield lower, a 10-year to 205. At what point do you put some of that cash to work that you were talking about? Do bond yields rise up to catch up with a higher growth scenario of where the equity prices are pricing in? Or do equity prices fall to match a lower for longer scenario at which the bond markets are pricing in?
Yeah. I think, what I think we're going to see, not unlike since the global financial crisis, right? We have a lot of liquidity in the system. We have the ECB, tomorrow probably making a rate cut potentially. And so there's a lot of reason to believe that this could continue. And when you think about equities and suddenly dividend stocks look attractive relative to low yields. So I think you're going to see this world happening for a while. So that being said, what are bond markets telling us right now, right? I think, you see that the bond market believes that the Fed's going to tighten 75 basis points. I believe they will, to be proactive, because if you're the Federal Reserve and you look around the world, you look at Japan, you look at the ECB, you don't want to go to negative rates. You don't want to risk it. And so I think they're going to err on being a little bit more aggressive in policy accommodation. So saying that, ultimately, you're going to see the yield curve steepen out a little bit. You'll see stable credit spreads. And so that doesn't necessarily mean that bonds and equities can't both stay at relatively strong levels for the rest of the year.
We'll go back to credit spreads for a second, because I've heard from a lot of equity investors when you talk about valuations, they look at credit and they say, well, as long as that's given us the green light, we don't really care what the multiple is on this particular stock or whatever the market is. Do you see any real risk, or I guess any outsized risk, I should say, in the credit side of the equation that investors elsewhere should be concerned about?
Within credit markets overall, no. Well, and let me explain. There's just been a lot of discussion around, say, triple B risk and lots of leverage in corporate America. Is that true? Yes. However, it's a little bit overdone. So when you look at, say, triple B corporates, we're seeing a pivot out of CFOs to be a little bit more responsible about actually delevering. So just year to date, over 5% of that universe, they're actually deleveraging their balance sheet. So that extends the credit cycle. We have a very large CLO business at Voya Investment Management, and every time we turn around, right, whether it's Powell or whoever, they're talking about, the death of leveraged loans. We don't see that. Certainly, you're going to have defaults in areas like retail. That's natural at this point in the credit cycle. I would say where we're a little bit more concerned would be in middle market lending and BDCs. There's just not a lot of transparency. When you see the capital raise in private markets, And in some pockets, what they're paying for some of these opportunities, they look a little rich. And so the unknown thing, if you're Chairman Powell and you're the Federal Reserve, you don't have a lot of transparency on who owns that and what's the extent of the risk.